Did you know the CRA can slap you with a massive tax bill on your TFSA, up to 50% of the fair market value and even a 100% fine in certain cases? My recent video about the CRA's Watching Your TFSA absolutely blew up, and the comments were wild. One of them really caught my attention. A viewer shared a story of how he did nothing illegal, but because he made too much money, the CRA went after him under a little-known rule called advantage. He described it as a mafia-style shakedown, where they gave him a choice: take a deal and pay the penalty, or fight them in court and go broke. Basically, they made him an offer that he couldn't refuse. That story intrigued me, so I went deep into the rabbit hole researching the banned TFSA investments that can trigger massive CRA fines, including how this mysterious advantage rule works. What I found was shocking: legal investments getting retroactively taxed, investors blindsided, and vicious court battles that dragged on for years. Let me show you what I uncovered. The CRA crushes TFSA swap loophole. What if I told you that someone turned a $5,000 TFSA into over $200,000 completely tax-free within just 1 year? Well, that sounds like an incredible investing strategy, right? This person 40x'd her money. Well, that's exactly what Victoria Louis did. She used a sophisticated swap and derivative strategy to maximize her TFSA's tax advantage. But despite playing by the rules at the time, the CRA came after her hard. Back when the TFSA was a brand new account, between May and October of 2009, Louis executed 71 swap transactions, moving stocks between her TFSA, RRSP, and taxable brokerage account. These weren't reckless trades, they were calculated moves to legally shift investments into her TFSA at favorable prices. This strategy legally maximized tax-free gains inside her TFSA, allowing her to grow her account exponentially. What she did wasn't explicitly illegal, but the CRA didn't like it. The CRA cracks down. At first, the strategy worked as intended. But 3 years later, in 2012, the CRA reassessed her TFSA, hitting her with massive back taxes and penalties. They argued her transactions weren't legitimate investments, but instead a form of tax manipulation. They ruled that the swaps weren't arm's length, meaning no independent buyer or seller would agree to these price differences, and that her gains weren't from natural market growth, but from structured trades designed to maximize tax-free returns. Louis fought back, arguing that her transactions followed TFSA rules, but the CRA had another weapon: the advantage rule. This obscure rule allows them to retroactively invalidate legal investment strategies if they think you're gaining an undue benefit. The tax court eventually sided with the CRA, ruling that the swaps were structured to exploit tax-free TFSA gains, not for genuine investing. They also ruled that the transaction wouldn't have happened in a real market setting, proving that they were only there for tax avoidance. And finally, they deemed that the inflated value of her TFSA was fully taxable, with additional penalties. She appealed to the Federal Court of Appeals in 2019, 10 years later, and lost again. The message was clear: even if your strategy is technically legal, if the CRA doesn't like it, they can still come after you. The bigger problem: could this happen to you? So here's the scary part: this wasn't just about Louis. The CRA has used the advantage rule to target many investors, even those who thought that they were following the rules. Remember that viewer comment we saw earlier? They claimed they didn't break any laws, but the CRA still hit them with penalties anyway. So what exactly is the advantage rule, and how can it quietly drain your TFSA without you even realizing it? Well, we'll get into that more towards the end of the video, including how to best avoid it. But let's first talk about something that's a lot more common that any investor can trip up on, which is investing in non-qualified investments. The CRA imposes a 50% tax on the fair market value of any non-qualified investments inside a TFSA. Many Canadians unknowingly invest in assets that don't meet the CRA's strict criteria, and they only find out when they get hit with a massive tax bill later. Some common non-qualified investments are private company shares, unless they're CRA approved. There's also foreign stocks not listed on a designated exchange, and certain debt instruments, such as promissory notes from private corporations. And here's a real-life example of the OTC stock trap. One investor, as shared in the comments of my previously mentioned viral video, bought stocks in a promising company listed on the NASDAQ, which was completely TFSA approved at the time. But when the stock plummeted and got delisted to the OTC, or the over-the-counter market, it suddenly became a non-qualified investment. Instead of just dealing with the financial loss of a bad investment, the CRA piled on a fine because OTC stocks aren't allowed in a TFSA. The comment read, "No one ever talks about this particular trap. Not brokers, not financial channels, not anywhere." Well, thanks to this person that commented, I learned something new and I'm mentioning it on my channel here. So make sure you leave any interesting stories in the comments on this video. This is kind of an easy mistake to make. Many investors assume that if a stock is initially TFSA eligible, it will always stay that way. But the moment it moves to, say, an OTC market, it's no longer a qualified investment, and the CRA will slap a 50% penalty on the value of the holding. So the key takeaways are to double check that all your investments remain TFSA eligible, even if they were approved when you bought them. This is especially true for people that like to dabble in things like penny stocks or day trading. If a stock gets delisted, act quickly to avoid penalties. And also avoid investing in private companies, unlisted foreign stocks, or debt instruments that don't qualify. Before we go on to our next bad investment, if you want to grow your TFSA without getting blindsided by the CRA, I put together a free guide that walks you through the 5 steps to building a $1 million TFSA without triggering massive taxes or penalties. You can download it now for free, the link is in the description. Next is the non-arm's length transactions, which is a red flag for the CRA. The CRA closely monitors TFSA investments that involve non-arm's length transactions. In other words, investments where you or your family members or someone you're close with have significant control or influence. These types of transactions trigger serious penalties because they can be used to shift wealth into a TFSA unfairly. So what triggers a non-arm's length penalty? Here are some examples. Investing in a private business where you or a family member has control, buying shares in a company that you or a relative owns more than 10% of, and structuring friendly transactions to boost your TFSA balance unfairly. Meet Bobby Axelrod, who spots a golden opportunity. He knows his business partner, Wag's new startup is about to explode. So he buys $50,000 worth of shares inside his TFSA, expecting to cash out millions, perhaps even billions, completely tax-free. But the CRA isn't asleep at the wheel. Since Axe has influence over the business and is not at arm's length, they slam him with a 50% penalty on the share's fair market value. That's $25,000 gone instantly, and a 100% tax on future gains. If those shares grow to $500,000, for example, the CRA takes all of it. Plus, he'll get a TFSA reassessment, wiping out his tax-free advantage. Axe might try to lawyer up and fight it, but even he can't bend the CRA rules. This is exactly how the taxman shuts down TFSA loopholes before they turn into billion-dollar plays. How to stay out of trouble? It's pretty simple. Don't invest in companies where you or your family members have ownership or control. Also, be wary of structuring transactions that could be seen as artificial tax advantages. And if a deal seems too good to be true within your TFSA, the CRA is likely watching. Now let's talk about the dreaded advantage rule. The CRA has a secret weapon called the advantage rule, and it's been catching investors off guard. At its core, the CRA defines an advantage as any benefit or debt tied to the existence of a TFSA, outside of normal investment activities or conventional incentive programs. If they decide you've gained an undue tax benefit, they can retroactively tax your gains at 100% and slap on massive penalties. On its website, here's what qualifies as an advantage in the CRA's eyes. First is artificially inflated returns. Any transaction that wouldn't normally happen in a normal commercial market, but is designed to take advantage of the TFSA's tax-free status. Then there's swap transactions, moving assets in and out of a TFSA in a way that maximizes tax-free gains while shifting taxable income elsewhere, similar to Victoria earlier. Payments in disguise. If income is received inside a TFSA instead of being paid as salary or dividends, the CRA can see it as tax avoidance. Then there's holding prohibited investments. Any capital gains or income generated from prohibited assets can be taxed up to 100%. There's also over-contributions. Deliberately exceeding your TFSA limit and letting the gains compound can trigger an advantage penalty. Here's the kicker: even if what you did was legal at the time, the CRA can retroactively change rules and reassess your TFSA years later. We just saw how Victoria Louis used sophisticated swaps to grow her TFSA from 5,000 to over 200,000, only to be hit with back taxes and penalties under the advantage rule years later. And she's not the only one. As mentioned earlier, a viewer on my last video at T. Griffiths shared this shocking experience, which inspired this entire video. Now, do keep in mind that this is his side of the story and we don't have the full details of the case. But he says here that the CRA admitted he broke no rules, but because his TFSA grew too much, they slapped him with an advantage charge anyways. They gave him a choice, pay a fine or fight in court and go broke. And it wasn't just him, his coworkers who used the same legal investment strategy also got targeted. So a big thanks to T. Griffiths for sharing this eye-opening story. If you're watching, I would love to hear more details on this case in the comments on this video. This is why every TFSA investor needs to understand the CRA's shifting definitions of advantage. You don't have to break the law to get audited. Sometimes just making too much tax-free money using a complicated investment strategy is enough to get on their radar. I do wish I knew more details about what strategy he used, but it sounds like he might have been doing something similar to what Victoria Louis did with the swaps. But I don't know for sure. How to avoid the advantage trap? The CRA's definition of an advantage is intentionally vague and constantly evolving, but there are clear steps you can take to reduce your risk of getting hit with penalties. First is to stick to traditional investments. Things like stocks, ETFs, and bonds inside your TFSAs are much safer bets than, say, complex strategies. You can also avoid private company shares. If you or a family member have control, it's a red flag for the CRA. And be cautious with things like swaps and structured trades. Even if they're legal, they're a magnet for CRA audits. Make sure you monitor your holdings. Just because an asset was TFSA eligible when you bought it doesn't mean it still is. Delistings and reclassifications can turn a valid investment into a tax nightmare. Also, consider getting expert guidance. If you're making big investment moves and aren't sure of the rules, talk to a professional to avoid an expensive mistake. My take on all this is I don't want to be too hard on the CRA. They're just doing their job. These shocking advantage penalty cases seem relatively rare and mostly affect those using highly complex trading strategies. However, there is a serious issue. Lack of clarity. It would be far better to have a clear official ruling on what is and isn't allowed. And if something is legal at the time, taxpayers shouldn't be blindsided by retroactive penalties years later, like T. Griffiths and Victoria Louis. It would have been nice to see the CRA say, hey, you won this one fair and square, this wasn't against the rules, so keep your money. But we're gonna implement harsher rules for those that try this in the future. TFSA mistakes can cost you thousands, but smart planning can save you even more. At Blueprint Financial, we help Canadians invest tax efficiently and avoid costly missteps. Head to our website to learn more, and don't forget to like, subscribe, and stay tuned. There's so much more to learn.